Good afternoon and welcome to this Yellowstone Advisory webinar with Halma plc. We're delighted to have with us Charles King, Head of Investor Relations, and Melanie Horton, Deputy Head of Investor Relations.
Thanks, Alex. And there will now be a small technical pause while I share our presentation. And so bear with me for 1 second. Hopefully I can get that right. And hopefully you can all see that. So I'm Charles King, I'm the Head of Investor Relations here at Halma. I'm here with Melanie, my deputy. I'm going to run through our recent results, our full year results for the year to March, 31st of March 23, that we announced in mid-June, and I'll give you the highlights of those results. And then Melanie will give a few examples of Halma in action, so what we're doing in some of our companies, and also some examples of companies that we bought in the year as well. So bringing the story to life a little bit, but we'll start with the numbers. And on our first slide here, assuming I can get the slide to move forward, I can. So the 2023 year was a good one. We announced record results, another set of record results with very good continued strong growth, high returns, and importantly, substantial investment, more than £500 million invested to support our medium-term growth. Looking at the headline numbers, revenue was up 21% to 1.85 billion. And we delivered our 20th consecutive year of profit growth with profit of £361 million. I mentioned that we made substantial investments in the business of over £500 million. And that really, for me, reflects the scale of opportunities that we see in our markets. It's each of our individual companies investing behind those opportunities. Within that, as you'll see, very substantial investment, both organically and inorganically. So organically, we've continued to invest in products through R&D to build strength and diversity in our teams and to foster that entrepreneurial spirit that's so important to Halma by building on the power of our network throughout our nearly 50 companies. On the acquisition side, we had a record year for both spend and acquired revenue and profit. So we spent nearly £400 million on acquisitions in the year. And Melanie will give you a bit of an overview of some of those acquisitions that we made in the year a bit later in the presentation. That investment is supported by a strong financial position. So we ended the year with net debt to EBITDA at a modest level of 1.4 times. And there were high levels of cash generation, and it's really pleasing to see cash generation, cash conversion back to our targeted level of 90% in the second half of the year. And the growth continues to be delivered with strong levels of high returns. The return on sales was a little bit below last year's unusually high level, but well within our targeted range of 18 to 22%. And the ROTIC was also substantially ahead of our cost of capital. As you can see, 14.8% return on total invested capital, well ahead of our cost of capital, which we estimated at 8.9%. And all of that supported a further increase in the dividend, a 7% increase. And this is the 44th year that we've grown our annual dividend by 5% or more. It's another strong signal alongside that record investment of our confidence in the future. So all of that means, together with a good start to the new financial year, means that we're well positioned for further progress in 2024 and beyond. So let me look at that performance in a bit more detail, first by sector and then by geography. So looking at the sector performance, on the left-hand side, you can see the performance on a reported basis. That includes currency and the effect of acquisitions and disposals in the year. So I think probably better to look at the right-hand side, those organic constant currency growths that you see there. And you can see immediately there's broad-based growth, fairly evenly spread across the three sectors. So safety 11%, environmental analysis 9%, and healthcare 10%. So strong growth across all three sectors. And that reflects really the strong levels of customer demand that we're seeing for our products and services. In safety, we saw double-digit growth in both halves of the year. Organic growth was broadly spread across all 4 subsectors within safety. A very good year also in terms of M&A, with 4 acquisitions in the year, spending over £200 million. And in fire safety, for example, we purchased Thermocable and FirePro. Melanie, as I say, will go into the details behind some of those acquisitions a bit later on. And in power safety, we purchased 2 companies, VTech in Germany and a bolt-on for our Centric business called Zone Green. In environmental and analysis, all subsectors grew revenue on an organic constant currency basis. The growth was led by environmental monitoring, where growth on a reported basis also benefited from acquisitions. So we bought a business called Deep Trekker in the year, an underwater ROV business. And organic constant currency growth was also strong in gas detection, supported by the increasing demand for products addressing the minimization of emissions. Both optical analysis and water analysis and treatment subsectors saw good organic constant currency revenue growth as well. And photonics within optical analysis continuing to benefit from increasing demand for technologies that support the building of digital and data capabilities. It's fantastic to see building momentum in M&A with 2 acquisitions in the year in E&A, Deep Trekker, as I've already mentioned, and a bolt-on for Ocean Insight. And then after the year end, we've made 2 further acquisitions, a business called Sewertronics in Poland and a bolt-on for our Minicam business here in the UK. Finally, on healthcare, we saw double-digit organic revenue and profit growth. Organic revenue grew 10%, and that included a recovery in patient caseloads in the second year post-COVID. By geography in healthcare, all regions except Asia-Pacific reported double-digit revenue growth. Asia-Pacific declined on an organic basis, however, because of the lockdowns in China. Our sector growth in healthcare continues to be supported by a strong order book, reflecting high patient caseload levels and significant order backlogs. And we all know about the backlogs within medical and healthcare systems overall. And generally also, we saw very strong execution by sector companies, with all but 3 companies delivering organic constant currency revenue growth, and 5 of our companies achieving organic constant currency revenue growth of 15% or more. So very pleasing momentum across all 3 sectors. Cutting it by geography, it's a similar picture, frankly. On the left-hand side, again, you've got the reported, and on the right-hand side, the organic constant currency revenue growth by region. And again, if we focus on that chart on the right that analyzes the organic growth, we see strong growth in our 2 largest regions, the USA and Europe. And in the US, it was pleasing to see the growth evenly spread across all 3 sectors. In Europe, we saw strong growth in safety and healthcare. The UK growth at 6% was in line with our longer-term expectations, and very pleasing given that we were lapping a 25% organic growth in the previous year. Asia Pacific, a bit slower at 6%, but saw strong growth in Australia and India. That was obviously partly offset by the lockdown effect that I've already mentioned in China. Sorry, Asia Pacific up 3%, I beg your pardon. So looking at the performance against our KPIs, organic revenue growth in the year was 10.2%, and that follows on from growth of 17.5% in the prior year. So a continued strong performance. Within that 10.2%, we saw price increases, which provided 4% of the growth, and that was consistent across all 3 sectors and above the historic average range of 1 to 2%. Volume increases were therefore 6%, also at the high end of our historic range, and pleasing with that. And our growth continued to be driven by that underlying demand, which remains strong. Reported profit was up 14.2%, but organic profit was only up 3.1%. The organic constant currency growth was held back to some degree by the return on sales performance in the second half, and that was lower than the historic average for two reasons. Firstly, the safety sector was impacted by supply chain disruptions, and the interest expense was up due to the record level of investment in the year and obviously higher interest rates. We're guiding that the full year 2024 return on sales, so this year's return on sales, will improve to approximately 20% from the level of 19.5% in 2023. And that will be driven by recovery in the safety margin and the benefits we're seeing from the highly profitable acquisitions that we made recently. I mentioned that we had a strong acquisition performance, and you can see acquisition profit growth of 5%, 5.5% there. This is especially pleasing given that that metric is on a post-interest basis. So it includes that incremental cost of interest that we're seeing coming through as a result of higher rates. On a pre-interest basis, it would have been over 9%. Earnings per share in the year were up 17%, so well ahead of our KPI of 10%, driven by strong reported profit growth in the year. I've already mentioned it was really good to see cash conversion in the second half at 90%, which is our target level. In the first half, cash conversion was only 63%, and that was due to the decision by some of our companies to invest in inventory and stock to mitigate the supply chain issues we saw in the first half of the year. These issues are easing, and we expect cash conversion to be ahead of 90% in this financial year in FY24. And finally on this slide, return on total invested capital, as I've mentioned, remains strong, well above the cost of capital of 8.9%. And that was delivered at a time of record investment, supported by a strong cash generation and strong balance sheet. So looking at the longer term picture, which I know many of you will be interested in, these slides show the 10-year performance of the group at the reported level in terms of revenue and adjusted profit. And it's really excellent to see 10-year compound annual growth rate above 10% for both metrics. That demonstrates to me the effectiveness of our sustainable growth model, which is at the heart of our business. And Melanie will come on to talk about that sustainable growth model in a moment. We continue to achieve sustained value creation over the long term, and we seek to ensure that those returns continue to come through from the substantial organic and inorganic investments that the group has made and is making. So with that, let me hand over to Melanie, who will take a look at the future and some of the substantial opportunities for growth that we see in our markets.
Thank you, Charles. So this slide shows our sustainable growth model, which enables us to create value for our stakeholders over the long term. And that's through delivering the combination of both growth and returns you just heard from Charles. It's a dynamic system here represented by a sort of atom, and each of its elements are interlinked and they reinforce each other. And really at the heart of this sustainable growth model is our purpose. It's an ambitious purpose, one of growing a safer, cleaner, healthier future for everyone, every day. It also defines our culture, and it ensures that we focus on addressing solutions to challenges that are essential to people and the planet. Our purpose also directs us to the niches within the markets in which we operate. Halma's always focused on long-term growth drivers that underpin growth. That's both organic and inorganic growth, and I'll touch on these long-term growth drivers in a minute. All of this gives us confidence in delivering our sustainable financial model. Our strong organic growth, as you just heard from Charles, our returns and the high levels of cash that we generate allow us to constantly reinvest in growth opportunities, both organically in our businesses and through the acquisitions that we make. And also, and hopefully importantly to all of you, to deliver increasing dividends to our shareholders. The agility of this business model enables us to capture these opportunities over decades. And our agile business model puts our strong talent in our businesses close to those niche markets, and they can then make the most of our entrepreneurial and collaborative culture to innovate and to solve high value problems. So just moving on here to the right-hand side of the slide, Mark Ronchetti, who stepped up to the CEO role in April after serving 6 years as CFO in the business, outlined these 4 areas which he sees as key priorities for Halma as we look forward. And as you can see on the slide, these are very much in keeping with our model and strategy. So it's very much a case of evolution, not revolution. Moving on to the next slide and covering these long-term growth drivers. These show the long-term and fundamental trends which drive growth in the niches within the broad market areas in which our companies operate. The growth drivers reflect demographic trends, increasing demands on infrastructure and natural resources, and growing sustainability-related opportunities. So first of all, really importantly, the increasing demand for healthcare as people live longer and chronic conditions are more prevalent. Also, as diagnosis and treatment options evolve, and also as the efficiency and the standard of care increases in healthcare settings. Secondly, the growing need to protect life-critical natural resources such as clean air, water, as they're increasingly threatened by scarcity, pollution, and increasing demands like population growth and climate change. Third, global efforts to address climate change, waste and pollution as these impacts become more severe and as populations are increasingly affected by climate change. And then fourth on this slide, a growing need to improve the safety and efficiency of vital industry and infrastructure as populations grow and urbanize, and as the demand for automation and infrastructure systems continue to increase. In each of these 4 areas, growth is underpinned by increasing regulation for safety, health, and the environment. And this is as governments and regulators demand higher standards in response to these challenges. So while these long-term drivers that underpin our growth have not changed, it's clear that sustainability challenges are intensifying rapidly, and they're now front page news, as you can see from recent newspaper clippings on the next slide. These challenges are driving billions of pounds of new investment globally into renewable energy, electrification, clean technologies, healthcare systems, and into automation and digitalization. And for us, they represent huge opportunities. So I'll try and now bring this to life by looking at some examples of how we're evolving our portfolio to capture these opportunities, aligned to our key themes within our safer, cleaner, and healthier purpose. So first of all, a great example of one of our companies that had historically focused on the oil and gas and chemical processing industries, now using their safety solutions to solve a new challenge. In this case, it's a challenge arising both from climate change and the energy transition. Asseco Elfab has customized its technology to support the rapid evolution of electricity distribution networks as part of the green energy transition. Specifically, this solution enables the elimination of SF6, and bear with me, that's sulfur hexafluoride, if I've said that correctly, as an insulating gas used in electrical switchgear, replacing it with clean air. This is really critical given that SF6 is a very potent greenhouse gas. It has around 24,000 times the warming potential of CO2. So Asseco's solution enables a much greener transition to new forms of energy. The second example on this slide is a great example of 2 of our companies collaborating to respond to new opportunities. Sensit and Crocon, 2 of our gas detection companies, joined forces to respond to the rapid growth in demand for air quality monitoring products in Europe. This growth is being driven by countries developing clean air strategies and introducing tighter regulations to protect people's health. The collaboration resulted in a new series of air quality monitors sold into the European market that provide real-time insights into the air we breathe. And an example of where you can see this in the UK, they use, for example, in Kent, between the busy port of Sheerness to the north and the M2 motorway to the south. This is an area which regularly exceeds the national limits for air pollution. And finally, on this slide, an example in one of our healthcare companies responding with agility to the increased incidence of disease in aging populations, while ensuring that their customers can meet ever more stringent regulatory requirements. So our company, Longer Pump, is based in China. It was challenged by a long-standing Chinese medical equipment customer to develop a custom-built pump for its new dialysis machine. The team there were able to adapt their existing technology to provide a high-quality solution at speed to the customer to help them meet this fast-growing healthcare need. So these are just a few of the many great examples across the group. Hopefully they give you a flavor of the fantastic work we're seeing in our companies, ensuring that we do more good and do less harm. Turning now to how we're evolving our portfolio through the acquisitions. So you can see here many of the same themes in the nearly 400 million of acquisitions we made in the year. I won't go through all of these in detail, but just give you a flavor of the opportunities here for us. These are all fantastic additions to the group, and we've no doubt they'll form the basis of our organic growth going forward. For example, a number of the companies here are enablers of the green energy transition. We've got VTech that Charles just mentioned. It does high voltage testing used in mass transit systems and also in electric vehicles. We've got Deep Trekker, who have underwater robots that inspect offshore renewable energy infrastructure. And also the third one at the top of the slide, FirePro's fire suppression products protect lithium battery power storage facilities. So all critical in the energy transition. And in healthcare, in the middle of the slide at the bottom, our focus is where we see increasing incidence of disease, often correlated with age, like diabetes and the Longer Pump example that I just talked about, and here with IZI Medical's products, which support the diagnosis and treatment of cancers. So really keeping things simple, at the most basic level, we acquire really great companies aligned to our purpose and culture, and we expand their growth and positive impact over decades. This is at a rate over and above what they could achieve on their own. But don't just take it from me. Before handing you back over to Charles to wrap up, let me play you a short video so that you can hear from some of our companies, both ones that are new to the group, but ones that have been in the group for longer as well, about how being part of Halma has enabled them to achieve their ambitions.
What attracted to me to Halma initially was a very defined focus on making the world a better place. It's very consistent with our mission-driven sensibility here at Peregrine.
In doing our research on Halma, I really enjoyed that the company had a very clear purpose. I also love that the company has a network of a variety of different companies who have been there and done it. I can always reach out to one of the Halma presidents and managing directors with any problem that I might have had and find someone who has been there and done it before.
The advantage with getting into a group like Halma is that they have a lot of companies under their umbrella, so somebody have been on your problem before you actually get there, so you can reach out and get a lot of answers.
依托英国豪迈集团的国际网络和各个子公司的资源，兰格加速了海外市场的开拓。10年来，海外销售额翻了一番。
We wanted to get part of Halma because of keeping the autonomy to run our business and have a long-term home.
I thought Halma was a great fit for Peregrine because they had a bit of a longer-term view than our current investors.
When I was in the process of selling, where I had some help on the sideline, was actually that the people that I was going to sell to had a strategy behind it.
Seit 2007 ist Ries der ein Teil von Halma-Familie. Als Riester zu Halma kam, haben wir das bewahren, was uns besonders macht. Unsere deutsche Mark, unser Erbe und unsere Kultur.
When I heard about Halma, on their website I read quite a lot about the culture and also the purpose. Safer, cleaner, healthier future for everyone every day. And when I met the people of Halma, I had the feeling it's not only ink on the paper, but they live that culture. With the hubs in China, in India, and in the US, we have the possibility to grow international.
Deep Trekker's now been part of the Halma family for about a year, and we've really found that having Halma working with us has allowed us to refine our strategy and really bring focus to our business to allow for continued growth.
Okay, so just to wrap up, 2023, as you've heard, was another successful year for Halma. It reflects the benefits we derive from our sustainable growth model and the contributions from everyone in the group. We've made a positive start to the new financial year. We have a strong order book, and as at the date of our results, order intake in the year was broadly in line with revenue and ahead of the comparable period last year. And as we said at the results, based on current market conditions, we expect to deliver good organic constant currency revenue growth in the year ahead, and for return on sales to increase to approximately 20%. Overall, we're well positioned to make further good progress this year and in the longer term. With that, we have some time for questions. I think I'll stop sharing the screen, and I'll hand it back to Alex.
Brilliant. Thank you, Charles. Thank you, Melanie, for going through that very clear presentation. I mean, it's amazing again that, you know, revenues and profits and dividends continue to march steadily higher on a very consistent and sustainable way. So congratulations again for a very solid performance. As Charles said, we're now going to take questions. This is your chance to ask questions at the top of your mind. That we've had a couple that have come in ahead of time, and we're getting some couple that have come in already. But please, if you have a question, do ask it. Let me start here. Thanks for the presentation. Could you talk a bit more about your acquisition pipeline? How long does it take typically to build a relationship with a vendor to the point of transaction? And has the sharp change in debt cost softened vendor price expectations at all?
Yeah, so the pipeline remains very strong. So we always say that we're talking at any one time to more than 500 companies that we think we might want to buy. And I think the key for us is being disciplined around which companies we ultimately purchase. So, you know, we're probably buying 3, 4, 5 standalone companies in any one year and supplementing that with some bolt-ons for our individual companies to strengthen their market presence or their technological expertise. But there's no shortage of companies that we think we might want to buy out there. Often those companies come from the ideas for companies that go into our pipeline come from our companies themselves and the divisional chief executives who chair those companies. So, and the reason for that is that we're looking to buy companies that are pretty close to what we do already. We talk about adjacent markets or contiguous markets. So the example I always give is a couple of years ago, we bought a glaucoma surgery products company to go alongside our cataract surgery products company. So very similar markets, very similar technologies, very similar customers, very similar supply chains. So we don't make big leaps. We're constantly expanding our addressable markets bit by bit each year through those companies. And we get to know those companies. Sometimes it can be quite quick. It can be a matter of months. Sometimes it can take a very long time. And the process in one extreme case actually took us about 20 years to buy a company. But more typically, I would say between 6 months and a couple of years is the typical time frame that we have to get to know those companies. So we're not rushing. We're not going into fast-paced auction processes. We're buying good performing, nicely growing, privately owned companies in private transactions. And really that's the key to our model. And that means that the risk that we're taking, because these are not transformative acquisitions, they're relatively small acquisitions in the overall scale of things, the risks that we're taking are very well managed as part of that process. We get to know the companies and their management teams, and importantly, they get to know us as well. So there are very few illusions on either side when the company comes into Halma. We know them very well, they know us very well as well.
Great, thank you. Got a sort of related question to that, which is, has the sort of higher interest rate environment impacted the M&A strategy at all?
No, not really. I mean, we're buying companies typically on the sort of 10 to 12 times EBIT range. That's still very much the case. Arguably, there is a bit more opportunity potentially out there at the moment. Some of our competition for potential buyers for those companies perhaps are a little bit more affected by interest rates, but we've got as you heard, with 1.4 times net debt to EBITDA, very healthy levels of interest cover. We've got plenty of firepower out there. So maybe there's a little bit more opportunity for us out there. But in terms of our capacity to do deals, that's not really been affected at all. And I'd hope that 2024 is another good year like 2023 was. We'll wait and see. It's always inherently difficult to predict how many deals we'll do in a year because, as I say, we are buying those small private businesses in private transactions.
Thank you. You mentioned during the presentation a new CEO and their sort of 4 focus areas. So we've got a question on that here, which is, have you noticed any change in strategy or culture under the new CEO?
I think, look, there's always going to be change. So under Andrew, our previous CEO, under Andrew Williams, our previous CEO, we saw continued evolution of the model, but the fundamentals of that sustainable growth model really didn't change. It clearly adapted with the digital revolution. Maybe it will adapt now with AI coming in, for example, as well. So we're constantly evolving the model for current market conditions, and as the group grows, clearly we've needed to evolve the model to take account of that as well. But I think it's much more that continued evolution rather than revolution. And you'd expect that, given that Mark had been CFO for 5-6 years before he became CEO. It would be surprising if he'd sat on the board and hadn't been trying to engineer change if he felt very strongly and very differently about it. So the continued success that we've had in the model, I would expect to continue and to be, to continue to evolve under Mark over a period of time, but I wouldn't expect any substantial revolutions at all. Clearly Mark, as a CEO, will put his own imprint on the culture of the group, but again, the fundamentals of a collaborative culture, an entrepreneurial culture, and a low ego culture, I would not expect to change because they're so fundamental to the success of Halma.
Okay, thank you. Another question here, sort of looking forward. Do you think you'll be able to grow revenues and profits as fast in the next 5 years as you have in the last 5 years?
Well, given the scale of opportunities, I'd certainly hope so. I mean, the last 5 years have obviously been a bit unusual. We've had COVID in the way, but you'll have seen that you saw the chart of growth over the last 10 years, 11-12% revenue profit growth over that period of time, so above our 10% KPI. If I look over the last 5 years, we grew organic revenues by 6.5% compound annual growth rate over that period of time. That seems a very achievable level of organic growth within the business overall, especially given those very strong opportunities that we see. Obviously, on top of that, we have good M&A momentum, as you heard as well. So it certainly doesn't seem unachievable that we, having grown double digits over the last 10 years, that we shouldn't continue to grow double digits over the next 10 years. What makes me really optimistic about that is the level of opportunity, and arguably those opportunities are greater than they've ever been, partly because of our own capabilities, but partly because the problems we're solving for our customers are bigger than ever. If you think of the problems of healthcare systems and the backlogs that they've got of people waiting for treatment, if you think of climate change, for example, and the way that's affecting all of our lives, those problems are very substantial. And from our perspective, they provide us with great opportunities for future growth. So I would certainly hope that we can continue that track record into the future.
Okay, thank you. Got a couple of questions here about revenue growth and sort of impact of stripping out various pricing movements and inflation. So I'm going to ask this one specifically. So underlying profit growth after stripping out a 9% benefit from currency movements was just 5.2%, well under inflation. For the current year, what are the prospects for underlying profit growth returning to real growth?
Yeah, so I mean, actually, if I break it down from revenue, we saw very good volume growth at the top line, as you heard, 6% volume growth, 4% pricing. We do expect that pricing element to moderate in the coming year, so probably more to 1 to 2% rather than 4%. That's partly because we're lapping 2 years of 4% increases, and partly actually because some of those inflationary pressures we've seen have subsided. That 4% has been sufficient to keep our gross margins at a pretty stable level. What we did see, though, of course, is as I mentioned, the impact of supply chain challenges within our safety sector affect the margin overall, and that was our overall margin in the year. Our return on sales, as we call this, an adjusted PBT margin, was 19.5%. We did expect that to improve to 20% in the coming year, and that's going to drive stronger growth at the profit level than at the revenue level. So we're guiding to organic growth at the revenue level of 6%. With that profit growth, that's going to be much stronger. With that margin growth, margin expansion to 20%, that's going to be much stronger at the profit line. So I'd expect good profit momentum as we move forward in FY24. The unknown, as ever, is the benefit from acquisitions, and as I say, those are inherently difficult to predict, but we would certainly expect to see a benefit from acquisitions in FY24. We've made a couple of acquisitions already this year. I'd hope to be able to announce more as the year progresses.
Brilliant. And look, as a reminder, if you do want to ask a question, please type it into the chat box at the bottom of your screen. And it would really help me if you could write a sentence rather than just a couple of words, so I know exactly what you're meaning, so I don't ask something which is doesn't make any sense. So something in there at the moment, I've no idea what it means, so I'm going to pass on it. But if you're able to repeat the question, that would be great. Let me come to a question now on debt. Debt grew to 30% of revenues, which I believe is the highest ratio for at least 18 years and possibly much longer. Is this seen as a new normal for Halma, or is this likely to be the high point?
Yeah, I actually don't regard the debt as being in any way stretched. We're, as I say, we're at 1.4 times net debt to EBITDA. We say that, you know, we have a limit, if you like, of 2 times net debt to EBITDA. We've actually, in the last decade, we've never been anywhere near that. And that comes back to me, you know, why have we never really been near that? Comes back to me to the very, very strong cash generative capabilities of the business. The reason debt was high at the year end is that we closed a fairly substantial acquisition literally a few days before the year end. So we had all the cost of that acquisition coming in. The acquisition was FirePro, which we bought for about £130 million. Melanie is nodding just to keep me on track. So we had all the cost of that acquisition, that FirePro acquisition, come in a few days before the year end, and none of the benefits from the profitability. As we move forward, if we did nothing in terms of acquisitions during the course of this year, we'd pay down a substantial proportion of that debt, and probably getting on for something like a turn of net debt to EBITDA. So that net debt to EBITDA ratio will probably come down from 1.4 times to something like 0.5 times, that kind of territory. Now, clearly, we hope to make more acquisitions in the year, but you know, we'd also expect that to be strongly offset by the cash generation within the business. So I'm not going to predict what our net debt's going to be. I don't know how many acquisitions we're going to make, but what I can predict is that we will maintain a conservatively positioned balance sheet. That's where we are now, and that's where I'd expect us to be in FY24.
Thank you. Again, staying on the acquisition tack, you know, question here: as Halma gets even larger, do acquisitions have to be even bigger to have a significant impact on the bottom line? And I guess that question is, does that mean you can't have, or there's no point making any sort of very small acquisitions anymore?
Well, I think there's room for both, is the answer. So, I mean, we will probably make slightly bigger acquisitions and slightly more of those bigger acquisitions as we grow in the future. That being said, when you look at the targets that we've set, we're still very much buying small and medium-sized businesses. So, you know, that model of buying relatively small privately controlled companies in private transactions doesn't go away. We will need to do slightly more of them, but there's also very much a role for buying smaller businesses within the group. typically by our individual companies, buying them as bolt-ons for their existing businesses. And as I mentioned in the presentation, those are either for market reach purposes, so taking them into new market areas, or giving them access to technology that otherwise they'd have to develop themselves. So I think there's role for both. And actually you saw that during the course of the 2023 financial year. We made 7 acquisitions, 4 I think were standalone companies, 3 were bolt-ons for our existing companies. And those bolt-ons can be very small in some cases, but be highly value added for those companies. In the prior year, we made 1 bolt-on for £400,000, for example, but that's been a huge benefit in terms of technology and input into that company, and they've been able to scale that very substantially. So look, I think we'll do probably a few more and a few slightly larger standalone businesses, still nothing that's transformative within the group. So staying away from those high-risk transformational acquisitions, and we'll probably supplement that with a number of bolt-ons in the existing companies. And as I say, the pipeline remains very healthy, and we've got plenty of firepower financially to complete those acquisitions.
And I think also just adding there, I think it's important to note that we've invested in our M&A capability. So we've got 3 sector teams that focus on M&A that help our non-executive chairs of our companies do that M&A, to carry that M&A over the line, and also map the markets that we're interested in and where we want to play in M&A. And I think the other piece, having invested in that, we also have within our companies themselves, the managing directors of those companies have a lot more experience of doing M&A themselves. We did 10 bolt-on acquisitions in the FY22 financial year. We did another 4 bolt-on acquisitions last year. That's on top of our standalone acquisitions. So we have many more people who are capable and who have the experience of doing M&A. So we're able to do more M&A as a group.
Brilliant. We have no more outstanding questions. So that brings us to the end of today's webinar with Halma. Thank you to Charles and Melanie for presenting so clearly and answering those questions. As you leave today, you'll come to a series of questions yourselves about some feedback. It'd be really appreciated if you could give some comments. I know management really appreciate that. And all there is for me to say is flag up a webinar coming in a couple of weeks' time for another company. We've got Kenmare Resources reporting their half-year results on the 15th of August and a webinar on the 17th. And again, thank you to Charles and Melanie for presenting, and we hope to see you all soon.
Thank you very much, everyone, for joining. We'll see you again soon. Thank you. Thanks, Alex.